The semi-enhanced yield fund is managed using exactly the same investment philosophy as all our other funds. We don't differentiate between a retail fund and an institutional fund. So the investment philosophy is called pragmatic value. That sounds like a mouthful, but let me just very briefly explain. Pragmatic value means that we concentrate on value. We don't trade bonds. We try to identify value in the market. That might be in the bond market, it might be in inflation-linked bonds, it might be in corporate bonds. And then if we can find something that presents value, we would typically buy that. If you think something is expensive based on our measure of value, we will typically sell that investment. The pragmatic part of investment philosophy is also important, because that means that we need to take into consideration changes to the regulatory framework, changes to the level of international bond yields perhaps, and even changes to the banking environment in South Africa or the regulatory environment as far as the CISCA portfolio is concerned. So that's the investment philosophy. The process is also important, but the process might be a bit boring. So let me just highlight one or two aspects related to the process. The first is we strongly believe in individual accountability. So the person managing this fund is accountable to the investors. There's no team-based approach here. However, the person managing this fund does leverage off a shared platform. In other words, if the person is not there, the management of the portfolio can carry on, but ultimately it's one person being responsible to investors. The semi-enhanced yield fund was created specifically to enhance yield. This means that we're not a money market fund, and the semi-enhanced yield fund will never have the characteristics of a money market fund. At the same time, this fund is not a total return fund either. So the capital volatility is fairly low in this fund compared to some of the competitors that we have there. But I think it's important to realize that this is not a fund that is a one size fits all. It's specifically aimed at those investors that want yield, and not necessarily those investors that ultimately want capital protection. The enhanced yield fund has a duration of 1.2 years at the moment, which means it's considerably longer still than a typical money market fund, which is only allowed to have a weighted average maturity of 90 days as we speak. So it is more aggressive than a money market fund. But at the same time, at 1.2 years, the duration is considerably lower than we might go at 2 years or perhaps 1.5 years. And the reason for that is interest rates are fairly low. And in the last month or two, interest rates have also come down a little bit, at least the front end of the yield curve. And we are cognizant of not having a negative monthly return. If interest rates were to go up though, for whatever reason, whether that's capital flows, whether it's weakening the currency, whether it's a change in the international environment, we would most likely increase the duration of the fund. Credit is a very important part of the semi-enhanced yield fund. In fact, I can perhaps also just add that we do want to be true to label, and the name of the fund is a very good description of what we do from a credit perspective as well. So the credit exposure, meaning the non-sovereign exposure in the portfolio, would be at least 90%. And in fact, if we can have it our way, we'll probably get it as close to 100% as possible. That means the major risk in this fund is not capital volatility, but rather credit risk. So we need to have a very good process to try and differentiate between credit-worthy counterparties and that perhaps less credit-worthy. And in order to do that, we've got a credit process. We've got our own credit analysts, and the role of the credit analyst is to analyze credit counterparties with the idea of giving a credit rating. So they might put a AAA credit rating on a specific counterparty, which presumably means that it's a fairly safe counterparty. And then we will have a lot of confidence investing in this counterparty. But equally, we might have a BBB counterparty, and then we can still invest but with less confidence. So credit ratings are very important. So we have a framework. All these frameworks are subject to a central credit policy, and the central credit policy is put in place by the Central Credit Committee, which is really a Sanlam board committee. So Sanlam is also very mindful of its reputation when it comes to investment in credit, and that should actually be a bit of an assuring aspect for potential investors in our fund. SIM is in a very fortunate position that we manage 186 billion rand, which means that there's a lot of internal liquidity. If we now have a withdrawal from the semi-enhanced yield fund, we should be able to sell an asset, even if it's an illiquid asset, into another portfolio where clients can benefit from having exposure to this asset. So this actually gives SIM, as a large institutional investor and a large retail investor, a competitive advantage over most of our competitors. With With interest rates in South Africa at about 5.5% if you talk about money market rates, or perhaps 7.5% if you talk about a 10-year government bond, there's a huge search for yield. A lot of investors have also invested in money market portfolios in anticipation of interest rates rising. And now they're sitting with a situation where they're getting a very marginal return, and in fact a return equal to inflation. So there is the search for yield, which means that the credit market is for the most part a very crowded market. There's a lot of things that I might have said here that you would also hear from other investors. So what sets Sims apart when it comes to credit investments? I think key to our value proposition is the fact that we do our own origination. We've got our own credit analysts, but we also have an origination department. This department goes out on a proactive basis, approaches potential clients, and on this basis we also lend to corporates in South Africa that we wouldn't otherwise have access to. This means that we've got an extended investable universe compared to many of our competitors. Sim Enhanced Yield Fund is for an investor who has income in mind. This means that it's probably an investor who will not require capital in the next year or so, but will probably require some sort of capital in the next 2 or next 3 years. So this typical investor for the Sim Enhanced Yield Fund is an investor with an investment horizon longer than 1 year, but probably shorter than 5 years. And the investment horizon, in fact, links up very much with the duration of the fund. At about 1.2 years currently, it means that within about 1.2 years, the entire investment in the portfolio will mature. With interest rates at 6% in South Africa, 5.5% if you invested in the money market portfolio, a lot of potential investors are simply saying this is not sufficient to meet their income requirements. And there are income products in the market that promises 15% or even 20%. Now, when an income product guarantees or promises 15 or 20%, you as a potential investor should know that this is too good to be true, and you should really question those types of returns. So it's very important to have a realistic expectation of what you can potentially achieve in the income market.